Okay, so now we're going to jump back to this worst design, and we're going to start just doing some spot checking for different points in this policy so that we can kind of see the difference between the worst designs into the best designs. So let's look at year 10. In looking at year 10, we'll have put in $250,000 in premiums. We will have cash value still not breaking even in year 10. So we've put in 250,000. We've got 221,000 in cash value. Yes, the accumulation value is 250. So that's not, the crediting is based off of the 250, but that's not fantastic. That's not what I want to see. And you can see when you compare this to either the optimized 25K fund, this has $105,000 in cash value less than the optimized one, and it has $352,000 less than the optimized max fund. But obviously the funding level is significantly higher on that one. So this is just for illustrative purposes. Really, the main comparisons of apples to apples would be with this the JKL columns with the same funding level. And let's spot check 20 years in. So this worst design 20 years in will have put in $500,000 in total premiums. We'll have $790,000 in cash value. That might, okay, you've made some money. It might seem interesting, but notice we're at $194,000 in cash value difference for this. So that's a big difference in cash value. And what this actually ends up being, so this is age 45. So what we're seeing here in this death benefit column as well, we can see that all along, this has the top death benefit when we're young, but when we get to age 45, 20 years into this policy, now the optimized policy overtakes it, and we then have $78,000 less death benefit than this worst design policy. So that's not only do you have less cash, but you have less death benefit. I don't think you're likely to die at 45, but as you get approaching these older years, then your likelihood of dying does increase. Okay, so we're going to walk through a couple of things for the last look at this worst design policy. And all of these should be funding to around 70, 71 years old. And at that point in this worst design policy, we're looking at having put in $1.15 million. We've got almost $6.2 million in cash value and $7.1 million in death benefit. But that's $1 million less in cash value and $1.25 million less in death benefit than the optimized funding at the same level of 25K. So that's not very good. And if we scroll down to maybe, let's just say, realistic times where you might pass away, 90 years old, we're looking at a lot of money in 22 million, almost 23 million in death benefit and 21 million in cash value. It's a lot of money, but it's significantly less than if you do the optimized design. So we'll walk through some of the bad design and spot check each of these policies here in a moment. Okay, now we're going to jump into the bad design policy to start looking at the different things. And so early on, we hadn't really gone through this too much, but we do have some cash value showing up by changing the design a little bit. Still the same funding level, but it's still not great. It doesn't look great to have put in 75,000 in 3 years and only have 53,000 that you have access to in that cash value. So let's spot check year 10. We're looking at having put in 250,000, so same as the worst design, and we've got 302,000 in cash value, and the death benefit, it's coming up, it's increasing, but the difference here at that 10 years in compared to the optimized design is we've got 23,000, almost 24,000 less in cash value and 21,000 less in death benefit. So we're starting to see this really pull apart, and that's going to only get worse as time goes on. Okay, so now we're going to jump to year 20, so like age 45. We've put in $500,000 into this policy. We're looking at around 946,000, 947 just about in cash value. Notice that the accumulation value and the cash value do match at this point. So that actually happens at year 12 or year 13 is where those surrender charges are where the insurance company is recouping their commission and their expenses for putting this policy in force, like the health assessment. All those things get recouped by year 13. So that's where accumulation value and cash value will equal. But we've got 946,000 in cash value, and that's 38,000 less than the optimized design, and $86,000 less than the death benefit for that optimized 25K fund. Okay, now we're going to jump to the age 70, or 71, and this is 46 years into this policy for this bad design. We've put in that same 1.15 million, just the same as that worst design, but we've got a good bit more cash than the other one. So 7 million in cash value, 8.1 in death benefit. But here, so as we're approaching this time, we're getting a little bit older, closer to possibly passing away. We've got $253,000 less in death benefit than the optimized policy, and 220,000 less in cash value. And so those cash value differences is what you can use to be building up your real estate portfolio. I've got videos on that, and becoming a millionaire quickly by using this to fund your real estate BRRRR purchases. And you can check out some of our content on that. But the cash value difference is a lot when you're talking about being able to use it for investing in cash flowing assets. All right. And lastly, we're going to look into the later years for this bad design policy. We can see here at age 90, we've got 12, 25, almost 26 million in death benefit, almost 25 million in cash value. We'll have put in $1.15 million. It's starting to look okay, and in these later years, these things look okay. They're not bad, and it's not the end of the world if you have these and you're able to stick it out for that amount of time. A lot of the way that we design is for that earlier liquidity, but still, we're looking at a difference with this bad design of 876,000 in death benefit at this time when you're quite possibly going to pass away, and 834,000 less in cash value. And you could have been using this as a retirement income stream, and so having the extra cash is helpful in doing things like income streams and things like that. This video is part of a series. Check out the playlist here. If you want to learn more broadly about net wealth finance as a strategy and whether it makes sense for you, check out this playlist. If you're already ready to book a meeting, then check the video description. We could work with you to determine whether or not this makes sense for you to employ in your life. Thanks for watching. We'll catch you in the next one.